Hi, this is Lara at Elliott Wave Stock Market with your daily analysis for Wednesday the 19th of August. I'm recording today's video now 9:45 p.m. Eastern Standard Time on Wednesday Eastern Time. I was expecting downward movement for the first wave count. It expects that to continue tomorrow, and it expects we should start to see some very explosive downward movement over the next few days. The target for the middle of a third wave to end there is at 2002. If we get a new low below 2079.30, that would strongly favour the first wave count. The second wave count now expects some sideways movement to complete a B wave triangle before the upward trend should resume. The first wave count needs a new high above 2103.47 to have any confidence at all in it at this stage. This is the first wave count, and this video will focus on most recent movement to see a discussion of the structure expected for primary wave 4. Look at last end of week analysis video linked to underneath this one. Primary 4 needs to start with a 5 down. We have 1, a big deep expanded flat for 2, and 3 will reach 4.236, the length of 1 at 1983. Minute 3 may only subdivide as an impulse. So far we have minuet 1, minuet 2 a deep zigzag, and minuet 3 has begun with a leading expanding diagonal for a first wave, another deep zigzag for another deep second wave correction. The final invalidation point for this idea, though, is going to remain up here at 2134.72. It is possible that minute 2 could drift sideways as a combination or a double flat. If it does that, it can't move beyond the start of 1 above 2134.72. Let's have a look at how the middle of the third wave may be beginning at the hourly chart level, where the ending diagonal ends down here. This point down here. From this low to this high, it subdivides nicely as a double zigzag WXY. It's a deep second wave correction. On the 5-minute chart, this downward movement subdivides perfectly as a 5-wave impulse, and this upward movement will not subdivide as a 5-wave structure, and so it must be a 3-wave structure. It's another deep second wave correction. It's not showing up at the daily chart level, which means when it comes, its corresponding 4th wave for micro 4 should also not show up at the daily chart level. What that means is, for the S&P, it should be entering the very strong part of the middle of its third wave, and that should be beginning over the next couple of days. That would expect pretty explosive downward movement. We have now 4 overlapping first and second waves. That's like a winding up of potential energy, and when that energy is released, it can be very explosive. A second wave correction, if it does continue, and it certainly could, if it does, it can't move beyond the start of 1 above 2103.47, but it is very likely to be over there. It's over 70% the depth of the first wave. Draw a base channel around this first and second wave. The third wave should have the power to break through the lower edge of that channel. Once price manages to break through this trend line, that may well be when we start to see a big increase in downward momentum. The target for minute 3 remains the same, to reach 1.618, the length of minute 1 at 2002. If that target is wrong, it's going to be too high. It might not be low enough. As some of the structure within it starts to unfold, as we get toward the middle of it, I'll look to see if I might need to recalculate that target. Let's have a look at the second wave count. Looking, instead of primary 3 being over here, what if it's continuing? The final zigzag now should be 5, an incomplete 3, and then would need a 5 up. These diagonal trend lines should be well adhered to. Sometimes we can have small overshoots of them, like we have on the lower tail of this candlestick, but I would not expect this trend line to be confidently breached. It should provide strong support for the second wave count. So if we get a breach of this pink line, that would strongly favour the first wave count. This is an ending contracting diagonal for minor wave 5. An ending diagonal requires all of the subwaves to be a zigzag and the 4th wave to overlap first wave price territory. I'm labelling this 4th wave as a double zigzag, relying on an interpretation of the rules of Frost and Prechter, which state that multiple zigzags may replace the may take the place of single zigzags. So we need a zigzag up for the final fifth wave, 5, incomplete B wave, and then we'd need a 5 up. Let's look at the possible triangle where A of the triangle would be a big time consuming zigzag down here, and here's that overshoot of the lower diagonal trend line. It's not a proper breach, it's just an overshoot. That's acceptable. Sometimes they do that. The triangle looks a bit odd, but the only other possible structure now for minuet wave B would be a combination, and that would allow the possibility of a new low below this point, but I'm not going to chart that because it has a low probability, because that would require the diagonal trend line to be confidently breached. And so I'm concluding that if minuet B is still underway, then it may well be as a triangle. A zigzag for A, a double zigzag for B, an incomplete zigzag for C. For a triangle, can't move beyond the end of A, below 2079.30, and then D, can't move beyond the end of B, or for a barrier triangle could be about the same place, and a final short little E wave down. So overall now the second wave count could just see choppy, overlapping sideways movement in an ever-decreasing range. It's not supported by MACD. Triangles normally hover closer to the zero line while they unfold, but not always, so this is entirely possible. I'm going to be using stock charts now for my regular technical analysis because it has so much more reliable data, particularly volume data, so I've created an account there. Stock charts data is telling us ADX is still below 15 and it's mostly flat. The market is not trending, the market is still consolidating. And since since ADX, the black ADX line started to turn down back here, that's when the market moved into a consolidation back in here. And so a range bound trading system would still be better used than a trend following system. But price is going to start to get quite squished soon. We've got these horizontal lines of resistance, and instead of the horizontal support lines, I'm now going to use the 200-day simple moving average because that continues to be where price is finding strong support. This 200-day simple moving average continues to rise up toward the horizontal resistance lines, and so price is getting squished between them. Something's going to have to give, and that will be a breakout. We know with 100% certainty that the market will start to trend again. It will break out of this consolidation. The question is, what direction? If we look at volume during this consolidation, it's this day here which has strongest volume. It's an upward day. That would indicate that the breakout, when it comes, would more likely be upward than downward. However, that's contradicted by these 2 days with rising volume. As price is falling, volume is increasing. The fall in price is supported by volume. That indicates we might be getting a downward breakout. But for volume on balance, I'd say this candlestick would be a better indicator, but it doesn't always work like that. It's an indicator to keep in mind and take into account, but it isn't completely definitive. We could still break out downward. While price is drifting sideways, overall volume is still declining, indicating that the consolidation is getting more mature, the breakout is getting a bit closer. On balance, volume is got a pretty strong trend line here. This is reasonably shallow. It's been tested 5 times, so it's highly technically significant. It goes back to the 26th of March this year. On balance, volume is coming down to touch that trend line that may very well provide quite a lot of support, and that would tell us that we should expect a wee bounce up in price at this point. Stochastics has not managed to reach overbought, and so there is room for the market to rise or fall. And so the regular technical analysis picture is not completely clear, and it doesn't support the first Elliott wave count. It does tell us, though, that the market is not trending. It tells us it's still range bound. It's just telling us that we might be more likely to get an upward breakout than downward. But this is the strongest piece of technical analysis on the chart. This long-held bull market trend line goes back to November 2011. It's reasonably shallow. It was repeatedly tested, and it has been breached twice. These 2 daily candlesticks here closed more than 3% of market value below the point at which the trend line was breached. That bull market trend line tells us the market has changed from bull to bear, and that's contradicted by volume, but I think this piece of analysis is the strongest piece of analysis on this chart and trumps the volume confusing indicator. But the picture is a little bit unclear. That's all for me today with your S&P analysis. I hope all our members had a fabulous day.